Good morning and welcome to Attacq's pre-close update for June 2025. Certainly be an interesting few months since we've met with everyone at our interim results. But building on several encouraging months in our business, the overall market sentiment reflects a cautious but yet optimistic sentiment, with South African Reserve Bank giving us a little gift of the 25 pip interest rate cuts. However,
Let you know.
Is everyone muted? Can we quickly mute? All right. I think someone got really happy when we said 25 pips interest rate cut. But however, the undercurrent persists with the economic uncertainty that we operate in. Over the last part months in Attacq, we've navigated the sustained headwinds because there's really headwinds in our business, council approvals, infrastructure decay, that we continue to face challenging market environment. But we've been prioritizing our cost containment, driving operational efficiencies in our business. And also, despite the consumer, we always feel that's a little bit under pressure. Retail market has demonstrated notable resilience, and then Mike will talk to that a bit during today. And at Attacq, we've remained anchored with our strong fundamentals over the last few months, guided by our clear strategic direction, which is really focusing on waterfall and unlocking our precincts further, underpinned by disciplined capital allocation and a robust balance sheet, which we continue to maintain. We go to the updates. Don't you want to just press that for me? This thing is... there we go. There we go. We've seen our occupancy rate improved over the last few months to 93.2%. And it's really encouraging to see all of the great clients that we continue to introduce in Waterfall. The likes of Poorgertman Architects, Tiger Brands, corporate offices now being hosted in Waterfall. So very, very good to see the great activity in the commercial space. Our collection rate remains always high, and then some monthly trading density growth of between 2.2 and 7.2% for the year. And Mike will go through the detail of what's driving the growth in the retail market. We've done just over 25,000 square meters of new leases. This is in the commercial space for the year. We've completed 4.3 megawatt of solar, and we've got 2.6 currently undergo. With Mall of Africa, we're actually expanding our PV plant at Mall of Africa. So really great work that is happening within our portfolio. Over the last quarter, we've also completed the Ingress Building 3. So this was the first spec we embarked on post-COVID. You can say a 4,400 square meter building. And Mike and Dave will talk to the successes that we've achieved and what the successes led to. More development activity within Waterfall. Currently, just under 90,000 square meters of development activity, which a large component really focuses now on Waterfall Junction. As the Waterfall water connection is completed at Waterfall Junction, we're now busy with proclaiming and servicing phase 1 to 4 of the land. We continue to manage our water and the water resilience in our portfolio through active demand management, through logging and leak detection. We've also implemented a 5-day backup water. That's a project that is we're implementing over a 2-year period. I think around about 50-60% of the portfolio is completed. Mike and his team is busy with the balance of the portfolio, but really important to ensure that the resilience in our portfolio is maintained. Over the last year, we've also focused a lot on about operational excellence. And operational excellence is also how do we equip and empower our staff with great skill, but also great systems. And we've made the decision to also change over our property management system from Braille to an MRI system. And that system will go live in June, July of next year. But a very big system that overall, and this is phase 1 of 3 phases that we are implementing over the next 12 months. We've got a great refinance underway, and Raj will give update on the extent of that, but that's really margin compression and extending our tenor of some of our debt. Swap curve is always, I always say it's never an exact science. It's a bit of more of an art, but we've definitely, taken advantage of the reduced swap curve and making hedging more attractive over the last quarter. We're projecting in our FY25 year to end up with an ICR exceeding 2.5 times. Our gearing will remain below 30 and our liquidity will be in excess of R1 billion. Our capital allocation always remains sensible and disciplined with the waterfall development pipeline, specifically focusing on a lot of logistics, reinvestment within our portfolio. And there's some really exciting projects we are working on outside Waterfall to really ensure that our retail precincts remain dominant within the respective areas of trade. Green initiatives to ensure that we're not only green and responsible, but resilient, resilience we offer our clients, particular acquisitions within our portfolio we are looking at, and then some key assets that we are currently busy in negotiations from a recycling point of view. With that, we are on track to meet our guidance of dips with a growth of between 24 and 27%. And I'm going to ask Mike to go over and give us an update on the operational portfolio.
Good morning, everybody. I'm going to just back up some of the things that Jackie has said in her opening. So first of all, if we can start with the occupancy number as at 30 April. So Jackie mentioned that was 93.2. Just some more detail on that. If I can refer you to the blue and the green line on the chart to the right for occupancy. So the logistics sector still influenced by the one media unit that we need to let, as well as the vacancy of the ex-Dis-Chem warehouse. We've got strong leads on both of those boxes, but that has led to the decline in the blue line. But to counter that, a really strong increase in the occupancy and collaboration hubs. A lot of that sits in our waterfall portfolio, and certainly it gives us a lot of confidence to see the letting activity specifically in collab hubs in Waterfall City. If we think about future risks and some expiries into the future, our teams have been able to deal with a lot of those future expiries that we're going to come up next year now on an early preemptive basis. And we've been able to renew Auditor General and Cell C recently. So that's about 45,000 square meters of collab hub risk that we've taken care of. Of course, this also means that we now increase our WALE by doing renewals. We were able to renew SARS in the Brooklyn Bridge building. And with that renewal, we also added some new GLA, another 2,200 square meters of new take-up by SARS. And then very important just to note that we've agreed a renewal. All agreements have been signed with Ster-Kinekor Court for all 3 our cinemas that we do have with Ster-Kinekor Court. And we've also been able to secure renewals with Woolworths, Checkers and Cotton On, just a mention of a few that relate to Mall of Africa's 10-year renewal cycle that comes up in April 2026. So once again, very positive from a letting perspective and a risk perspective. If I maybe expand on a number of tailwinds and headwinds, some tailwinds that you would see in most property companies, I would presume, a lot less load shedding that happened in this financial period. We've seen that come out in a number of ways. Really difficult to quantify the exact numbers, but the first saving, very obvious on a retail portfolio, will be less expenses on common area costs when it comes to generating electricity through generators. But then another upside that's a bit harder to sort of calculate is the more efficient work of our PV and solar systems. So because they are grid tied and the grid is on for longer, the systems work better, and so we get a lot bigger benefit from our solar plants than we did in the prior financial year. Also, and I'll talk to it on the retail slide, we've seen a really big increase in the number of turnover rental invoices that we've issued this year. So that's a nice tailwind for us, as well as some increases in non-GLA income. From a headwind perspective, the Dis-Chem warehouse I mentioned earlier, that's been vacant for a big part of this year, is a bit of a drag on our performance, as well as some of these early renewals I've mentioned. So some of them we've done at a reset rental, one of them also with a small incentive this year, and that will lead to a little bit of a drag on this year's performance. If I flip across to the retail section, we've seen really good trade in our retail portfolio. I want to just stop still at the chart there, the trading density number. Maybe if I can use a golf analogy, the turnover metric is like a drive, a 300-meter drive. But what's really important is sinking that last putt, and that's trading density. So there's a difference between the two. For us, measuring the trading density is really important. This trading density number, as I mentioned in our half-year results, is impacted by 2 significant events. One, we increased Checkers at Mall of Africa by 2,000 square meters. So we've added GLA. And then another instance is where we've signed the lease with Bounce at Mall of Africa. So that's just under another 2,000 square meters. which is then attracting turnover that is not traditional retail, but sort of entertainment retail. So if you consider this, the results specifically for the 10 months we quote here is really positive. Maybe just narrating what the turnover growth numbers were. For January, it was up 7.2, Feb up 5.1, March up 6.3, and April up 9.9. So you'll see that there's a bit of a disconnect, but it's because of all the GLA we've added, and we feel that from a trade perspective, our assets are really healthy. Number of key highlights. We've got new stores that opened. These are all at Mall of Africa. North Face and Old School is open. Old School opened last week Friday. We opened it right next to Freedom of Movement. Really nice cluster of brands there. I think it'll do really well. A number of refurbs. You can see on the picture the lovely new Lacoste we've got at Mall of Africa. So that was one of the upgrades we've concluded, and the store opened in the last 6 months. And then Kate Spade and Coach are on the cards to be opening really soon. At Mall of Africa, we've seen a really nice growth in non-GLA income. That's up 18%. So that's our advertising income as well as exhibitions. And we're expecting just under 22 million rands worth of turnover rental for the year at Mall of Africa. At Waterfall Mall, we explained in a prior update the refurb we did to the mall that also included the upgrade and revamp of the Checkers. Interestingly enough, the Checkers on average is up about 16% since that revamp has been concluded. And just, I didn't want to put it in the slide, but in May, that number was actually up 50%. So a 50% increase in Checkers turnover after that upgrade and revamp. They do about 20% of that turnover is done through the 60/60 platform in Potchefstroom. So we're really happy with that sort of investment and the outcome. We also opened a KFC drive-through at Garden Route Mall. That's doubled the turnover that we now generate from the KFC. So the original franchisee was at a premises in the mall. We've converted that premises, and now it's a drive-through, and we've seen a double up in the turnover. So once again, a good outcome. And in general, once again, the beauty category trading really well. We've seen a lot of money move to that category. And then just confirming that for this year, we project that we will issue 86 turnover rental invoices. So once again, that's something to look out for. You know, as the results is the growth in turnover rent income that we will generate this year. I want to just stop at one really nice case study that we have. So over the last few years, at most of our results presentations, we communicated the growth in net rental income that we've continued to see in Waterfall City ever since 2022. Usually I would answer in that way when I get a question about the reversions, and we would say, but it's the growth in net rental that gives us confidence. It gave us enough confidence to greenlight a first spec building in a number of years in November of 2023. That spec building was the Ingress building. It was completed in April this year, 4,500 square meters added. But what's really significant is that half this building was pre-let before completion, and you will see that those leases will commence on the 1st of July. And we've got another 2 signed offers on this building with those leases commencing in January. So once again, from a capital allocation perspective, we were able to capture this sort of buoyant and more sustainable collab up market in Waterfall City by delivering the spec building on time, within budget, and having half the building pre-let at handover. I think is a fantastic result, and well done to David and his team for delivering that product to us.
Perfect. Thanks, Mike. Good morning, everybody. So talking about developments at Waterfall. So if we just touch on some highlights. So as Mike just mentioned, we've completed the Ingress Building 3 on spec. Obviously very excited of how well that's gone. Talking to doing it in a responsible way. Obviously, we had a 27 million rand basement sitting there, so that drove our decision. And then also what drove our decision is where we feel the market is. We are getting a number of office inquiries, which is obviously exciting. Obviously, not all nodes are like that, and we feel because of that, we need to provide the market with a product, but that product needs to be built. At this stage, to try and get a tenant-driven development in an office space is very difficult. So on the back of that, we've triggered Gateway East, which is going to be our next collaboration hub spec, about 11,000 squares, 10,000 a collaboration hub space if you strip out the retail component. Very excited about this for a number of reasons. One, we are converting lazy capex. The way the mall was designed when it was completed, the basements for the additional sites around the mall were completed at the same time. So there's an 80 million rand basement cost sitting there on our balance sheet for the last 10 years. So obviously developing a building on here does convert that. The Mall of Africa and the rights attached to it allows me the flexibility to shift bulk around. So initially this building was designed for closer to 14. As I said, we're doing 11,700. So we're not losing bulk. I can move it somewhere else, and we're able to work the design pretty hard. It's going to be an iconic development, obviously at the entrance to Waterfall on Lone Creek. And also what this is going to allow us to do is open up some further restaurant opportunities for the Mall of Africa team without having to obviously expand the mall. So we have got STP approval, and we're going to be triggering construction there during the course of July. We launched the Aspire, the new residential scheme, about a month ago with our JV partner Tricult. Attacq is a 25% shareholder in this development. It's gone exceptionally well. We've sold 97 units of the total of 217. We're busy trying to convert these into bankable, but that obviously totals 44% of the scheme. So it's really, really gone well within the market. As Jackie mentioned, we are in the process of proclaiming phase 1 at Waterfall Junction. This is obviously where a major big part of our focus as a development team is going to be over the next few years. We're also going to trigger the infrastructure from phases 1 to 4 to allow us flexibility for further tenant developments. Currently, we've got in total in our portfolio, as Jackie mentioned, 89,000 squares, close to 90 of development activity broken up between developments under construction as well as approved. And then we have provided an effective number there of 88 or 38,000, sorry. And that was roughly 1.1 billion. I've broken down the numbers in the chart below. So just to take you roughly through each development, obviously Lips you guys are all aware of. On track there to finish that in October of this year and transfer. We're a 20% shareholder in the final phase, and we're sitting currently with about 20 units left there. So that scheme's done exceptionally well. That's also a JV with Tricult. The Advantage Data Center, the second building, which we termed 12.1, on track for RFS date, which is the end of August of this year. So very excited to complete that. So that totals roughly 8,000 squares of effective development. We then, as I mentioned, Aspire, which is roughly 4,000 effective. Then the Client Warehouse. So this is our spec, it's not the spec warehouse. This is a tenant-driven development at Waterfall Junction. 25% shareholder there. Sanlam also going to be a 25% shareholder there, and then the client is taking 50%. Very excited that we have been able to land this transaction before even launching Waterfall Junction. So that reiterates, I think, the confidence we have in the land. Then LP3 Warehouse, so that's going to be a spec warehouse situated on phase 1 at Waterfall Junction. The intention is to develop that in line with the Client Warehouse. There we are 50% shareholder. Obviously, the other 50% is Sanlam. I'll take you guys through a little bit of the design metrics on that a little later. And then Gateway 8 East, as I mentioned. So just talking about some of the new development opportunities. On the left is the client-led warehouse that I mentioned earlier. Then the spec warehouse, which is the 22,000 square. So we made that generic. We feel it's important to do a spec there. It allows our deal team to anticipate potential tenant inquiries more quickly than rather having to design and then develop over a period of time. So we're expecting to finish at the back end of next year. It's going to be a 13.5 meter eaves, 40 meter yard. It is divisible. Obviously, that's not ideal, but to give flexibility, we designed it such like that. Then you've got Gateway East, as I've discussed, and then you've got a future pipeline. Not going to touch too much on this, but excited about a couple of these developments. Obviously, looking at the hotel there at Akerstad, which is our asset in Stellenbosch, and then a potential hotel and conference attached to the Mall of Africa. And then just touching on Aspire. So as I mentioned, 97 sales out of the 217 that we've done so far. These aren't bankable. We're obviously busy trying to convert these. Again, a JV with Tricult. And this is going to be an iconic development. 19 stories. So higher than Ellipse, but a little smaller than PwC. So it is going to be iconic. Excited that it's attached to the mall. And also there's going to be a big focus just generally on developments around the mall going forward, looking to densify the city. And obviously adding another residential development is also, there's going to be positives to the city as well as the Mall of Africa. So obviously all dependent on how sales go on when we kick off here. But so far, on the back of the sales, the development really looks like it's becoming a success.
Thanks, Dave. Talk a little bit about our funding. So on the next slide, I'll share with you some of the work that we're doing on a refinance. But first, let's maybe check where we are at the end of April. So drawn interest-bearing debt up approximately 700 million from last year, June. On a net basis, after we subtract our cash balances, that's only up 400 million. We've used that funding to complete Ingress Building 3, as well as fund the construction on our second data center. If you look at our available liquidity, very healthy at just under 1.5 billion. And then looking at our weighted average loan term, that's come down to 2.5 years. And maybe a great sort of opportunity to chat about the refinance that we're currently busy with, yet another one. So Pierre's been quite busy finalizing effectively a refinance on all of our debt with our funders, excluding the debt capital markets issuance that we did last year and the PwC tower loan that we refinanced in October last year. So that's about a 4.3 billion rand refinance. We're achieving lower margins, approximately 14 basis points across those facilities. We're also extending the tenor to 3.8 years, giving us a much more smoother sort of expiry profile. So you'll see at the bottom, that's the current debt and hedge maturity profile, a couple of big peaks there, and we'll have a much more sort of smoother profile over the next sort of 3 to 5 years as a result of the refinance. Hedging, we've also been quite busy with hedging. The swap curve has been coming down and quite volatile over the last week, but we've seen opportunities to enter into some new interest rate swaps, which we've done. We've taken our hedging coverage from about 75% to just over 87%, and that'll increase slightly into the new financial year as we've got a few forward starting hedges that will start in July of this calendar year. Our weighted average cost of debt on a variable basis has come down significantly since June last year. That's on the back of the PwC tower loan refinance, as well as a lower 3-month JIBAR curve. And then taking into account our hedges, our all-in weighted average cost of debt down 50 basis points down to 9.5%. And that's also driven by the additional hedges that we've put on the book in the last sort of 8 months at much lower rates than some of our historical hedges. Looking forward, if we think about weighted average cost of debt, we think that might end at about 9.3% at June once the refinance is complete. And also, I think looking forward beyond that, we see more of an opportunity to reduce our cost of debt, not with our bank funding. I think we're getting really competitive rates there. I think the opportunity lies in increasing the proportional funding that we get from the debt capital markets, currently at about 11%. If we increase that over time, we see that playing a much bigger role in our funding and potentially then reducing our overall weighted average cost of debt there. Thanks.
All right, we'll open up the floor for questions and answers. Thank you, team, for the update. Pete, is there any questions in the chat box? Nothing? I wanted Dave to put in a advertisement for who to call to sell more units today at the Aspire. Yeah, so if there's any questions from the call, I think just raise your hand or put in the chat box if there's any questions from anyone. Any questions, Peter? Nothing. Okay, so if there's no questions, we really appreciate your time for joining our pre-close. If there's any questions you haven't thought about, want to ask or reach out to us, please reach out to us, either Brenda, myself, Roger, anyone. We're always here to help assist and answer any questions. There's Francois Victoria. Hi, Francois.
Hi guys, can you hear me?
Yes.
Thanks. With nobody asking questions, I thought I'll drop a few questions then. Thanks for the opportunity. And just quickly on your debt refinancing, if you can give a bit of better picture on the timing of that expected reduction in cost of debt. So you expect cost of debt. So it sounds like quite a bit of the refinance is taking place currently and will be in place already by 30th of June, right? And so your weighted average cost of debt at that point sitting at 9.3%, assuming no further interest rate cuts, where do you expect that 9.3% to average out during FY26? Also, your peers have started giving us FY26 guidance. Maybe if you can give us some sort of a steer on that as well, maybe very broad outlook in that regard as well, please. I know you've tended to be a bit conservative in the past, but still be helpful if we can get some sort of steer there. Then maybe just on your new announcements in terms of I think the development, residential development specifically. Maybe if you can, you're developing to sell there, and you've given us how much you expect to spend there. What would you expect profit margins to be on that, and would that impact distributable income over the period of that development as well? So just those three questions from my side, please.
Yeah, so Francois, just on the debt, we're expecting to close most of the refinancing by the end of this financial year. So effectively in the next 4 business days, there might be 1 or 2 that end up being closed in the first week of July. That will take us to a 9.3% weighted average cost of debt. Looking into FY23, FY26 rather, excluding any sort of movement in terms of variable rates or base rates and so forth, I don't think it'll materially change, just because we've effectively refinanced all of our debt in the last 6 months. So the 4.3 billion now, plus the 1.3 billion that we concluded in October last year, being the PwC loan. So that's roughly 5.6 billion. And then the remaining debt that we've got is with the debt capital markets of about 760 million. We do potentially see ourselves coming back to the debt capital markets before the end of the calendar year. You'll recall our 3-year money cleared at about 129 basis points. That market still remains very buoyant. Obviously, we'll see what the geopolitical risk does to that, but I think it'll still remain fairly buoyant for the rest of the calendar year. And we believe there's probably 5 to 10 basis points that we can sort of compress in the debt capital market space. But given that, if we do another 750, for example, that'll take our total exposure to about 20% from 10%. It won't materially move our overall weighted average cost of debt. So I think 9.3, all things equal, is probably the right number to use for FY26. I think from a guidance perspective, Francois, you know that we typically provide that with our results presentation in September. I think wait for us then to give an update, or rather a full year guidance. We're obviously quite happy to see the collaboration hub market being quite active since the beginning of this financial year. We're filling up a lot of space, etc. Our retail seems to be performing relatively well. Our cost of debt is certainly well in control, and we've got a couple of developments coming online. But let's wait till September to give the market a bit of an update on what FY26 could look like. I think from a development perspective, on Aspire, our development margins there, both our GP, our gross profit margins, are somewhere between 22 and 25%, depending on where the final mix comes through between penthouses, executive apartments, and 1 bedrooms. It is a modular design, but between 22 and 25%. We'll be using the proceeds of those sales. So just a reminder that we're a 25% co-owner and co-developer in that development. So we're not taking the majority share of that. But the profits we do use to reinvest in other retail developments, residential developments, and or in the existing portfolio. So that doesn't feature as part of our distributable income or our distribution. It will not impact our distribution, certainly for FY25, being an 80% payout ratio on our distributable income, as we've previously communicated.
Thank you. Maybe just the last question on your logistics portfolio, where the vacancies increased a lot last year. It's started coming off a little bit in the last 6 months. Maybe if you can just talk to the market there, and what's driving your plans also for further logistics developments in the light of the increased vacancies last year, in the light of what has been flat rentals there over the last 3 years. Are you seeing in the last 6 months a meaningful improvement in that environment?
Francia, so maybe just unpack the current vacancy. So we finished 15,000 square meters of midi warehouses. It was 3 speculative midi warehouses, 3 S&B lease. We've got another so in this year, and we have another one that the team is busy working on an offer. Our one warehouse, K101 warehouse, was the ex-Dis-Chem warehouse. So that was always a space where Dis-Chem was looking for, consolidating in one bigger warehouse. So they vacated during the year, and we've got actually an offer that the team is currently signing this week on that. And then the last one was the Cell C restructure we did a few years ago, where it was the client walking center. I don't think you can actually call it warehouse, but we put it under logistics because there's nowhere else to park it in our portfolio. So that was 5,000 square meters, and actually Cell C has taken that up. So it was just an interim where, you do have developments completing, there's some leasing up period, plus then a client vacated, which we all knew, and we're busy leasing the space out. We've not seen downward reversions in our logistics portfolio. We've actually had a number of smaller warehouses that came up for renewal, and we've seen really great positive tension in upward reversion in warehousing. The new spec warehouse is completely a different type of product we're bringing to the market. This is a 20,000 square meter warehouse, very generic. And we see that there's either a market for smaller warehouses or a bigger warehouse. So this, for us, from a strategic point of view, is we feel that the market is there's quite a big need for this type of sized warehouses, and then the 5,000 square meter warehouse is a complete different market. So we try and play in different logistics markets to bring multiple clients to Waterfall.
Excellent, thank you.
One question I think that was stuck into the chat box around funding, and would we consider paying down all of our funding by issuing new unauthorized shares? And the answer to that is no. We think there's an optimal level of, let's call it, debt funding required in the business. Our gearing ratio is around 26.7% currently, and we've got that balance sheet capacity that we will utilize as we roll out Waterfall Junction. We don't think that would exceed 30% in the short term, definitely not 35% in the medium term. But we think there's an optimal level of gearing that the business does require, and certainly not looking to raise equity to pay down debt.
Other questions? Okay. No questions from the floor. So yeah, thank you so much for your time. Thank you for spending time with us, and to the Attacq team, thank you for your time. And we will see you at our results, or anytime reach out to us if there's any other questions. So thanks very much.